Hello and welcome to the Equity Residences National Webinar. This is Greg Sally. I'm one of the managing directors with Equity Residences, and I'm glad you could join us today. I'm here with John Long, our other managing director. And what we're going to do is we're going to take you through a very quick 15 to 20 minute overview, and we're going to save the Q&A till the end of the session. However, if you do have any questions along the way, at any time you can go ahead and type your question in. It'll come up on our screen, and we'll try to either address it along the way, or we'll circle back to it at the end and make sure we've answered everyone's questions. We're going to talk about our investment funds today, and we want to note that this is not an offer or solicitation. However, if you'd like more information about our funds, we can provide you with a private placement memorandum, which is available, as I said, on request. So, what is Equity Residences? Equity Residences is a luxury real estate private equity fund with our goal being to provide the most innovative and financially attractive vacation real estate investment vehicles on the market. Real estate investment, when I look at our team has collectively over 80 years of experience in real estate investment and development, shared use, private equity, and M&A. So we've got a very experienced team. Our fund has been around for about 2 years now. We've acquired some exceptional investments on behalf of our partners, and we're going to talk more about that as we go through. John?
Yeah, hi, this is John Long, one of the other managing directors of the fund. And what I want to start with is just our innovative and proven investment model for acquiring vacation properties. We believe, we know we've created really the most innovative and financially attractive model on the market, and it's pretty simple. We just start by acquiring a diversified portfolio of vacation properties as low as 30 cents on the dollar from the peak. We then cover all operating expenses of the properties in the fund from rental income. So that's a unique component of our fund, in is that our vacation properties that we're acquiring for our investors, we then rent, and we cover all the operating expenses of the portfolio. Simultaneously to renting the properties to qualified renters, we also then deliver lifestyle dividends to our investors, because with their investment in the fund, they get usage rights to the properties. And apart from just usage rights, our investors can also take rental dividends as an alternative to using the properties. At the end of the fund, we're going to sell the properties for a capital gain and distribute the proceeds to investors. So why invest in vacation properties as an asset class? There are a lot of hedge funds and private equity funds out buying single-family home real estate. Our luxury real estate private equity fund has focused on vacation properties. A reason for that is that vacation properties were hit very hard during the downturn. Many are recovering from 10-year lows. So we're out opportunistically capturing those opportunities. These properties that we're acquiring can be acquired below replacement cost and construction cost in most cases. It's creating very limited downside risk for long-term appreciation of these properties. These properties are also premium properties in prime locations. It's a limited resource that's going to drive higher future value. Separately, rental income can cover all holding and operating costs of the investment, which is a key element of the model. And then lastly, vacation properties are expected to take longer to bounce back. So distressed deals can still be sourced, and two of our most recent acquisitions that Greg's going to walk you through are quite proof positive that we're able to still buy this great value even in mid-2014.
So how do we find the best deals? We have a multifaceted approach where, first of all, it's very data-driven. We identify our target markets, target neighborhoods, target developments, and we go in and we analyze all the properties in the area, and we know exactly what we would be willing to pay for any given property when we have an opportunity to buy it in our target range. We have knowledge of the markets, which provide good rental yield and exceptional investor vacations. So we know where people want to go. We know where we can drive the right rental return to support our model and deliver returns for investors. We also cultivate local market context to identify opportunities as soon as they become available. We have the ability to move fast with all cash offers. We've made offers, in less than an hour. We've locked up properties that have come on the market because we knew exactly what the property was worth. We knew it was underpriced, and we were able to go in and secure it immediately. We also have experience in negotiating short sales and foreclosures with lien holders. So a lot of times lien holders will try to, they have a lot of experience more than the average buyer, and so they will try to bluff and do different tactics to try to drive up the price. And we've known when to call their bluff and how to actually even drive down the price when they're trying to drive up the price. We also have a willingness and expertise to remodel and our fixed structural issues that may scare other people. So your typical casual buyer of a property may get scared away by some things that we know and have experience in going in and dealing with and addressing. And finally, we're canvassing multiple markets simultaneously to source the best deals. So if an amazing property comes up in the Florida Keys, I'll buy that this afternoon. However, if the next amazing property comes up in Kauai or Lake Tahoe, I'll jump on that first. I have the flexibility to source them in any order. Next slide. So this is our most recent acquisition. This is a property that we closed on in early July. It's on the Big Island of Hawaii, and it has amazing sunset views from the lanai, as you can see in the picture. This property was purchased for $211 a square foot. That's the lowest price per square foot in that gated community that has happened in more than 10 years. It's below construction cost. And so if somebody were to get land in this development for free, which obviously would never happen, they still would not be able to build this property for the price that we bought it at. We're in the process of remodeling this property, so it's a 5-bedroom, 5-bath property, private pool, as you see the ocean and sunset views, in a gated community. It's going to sleep at least 12 people. It's got a huge great room, large gourmet kitchen. 4 of the 5 bedrooms all have ocean views. The great room has ocean views. I mean, it's a spectacular property. This property, once we complete our remodel, will have roughly just under $1 million into it. Early indications that this property will be worth in excess of $1.4 million once the remodel is complete. And we'll confirm that. We always go back once we complete our remodels and reassess the values so we can identify the type of returns that we're able to drive for our investors. Next slide. Here's another property that we acquired in June, and with both these properties, one of the key points to make, this one happens to be in Palm Beach Shores in Florida, but one of the key points to make is sometimes you hear that we can't still source amazing deals. But as you'll see, 2 months ago in July, we closed Big Island, Hawaii. 3 months ago in June, we closed Palm Beach Shores, Florida. And Palm Beach Shores, Florida is another example of a property that was bought below construction cost at $179 a square foot. This property is right by Sailfish Marina, which is widely known as having some of the best charter fishing in the United States. It's a couple blocks from the beach, just an amazing location, but it's also an awesome property. This property is 4,500 square feet. When we're done with it, it's going to have 6 bedrooms, 6 bathrooms, a huge gourmet kitchen, a media room. It's got 2, double car garages that we're going to stock with beach cruisers and different things to use. It's just an amazing property, and again, below construction cost. This one we purchased for around the same price. We're going to put roughly the same amount into the remodel, and this is another example where we'll see a significant return right away. This one will be worth in excess of $1.3 million when the remodel is done. John?
A third property example that we wanted to share with you was our recent Deer Valley acquisition. This property is extremely unique. If you look at the bottom of the page, this was a property we bought from a lien holder for $1.8 million. And I say property loosely, it's 2 properties. It's a 5-bedroom, 6-bath, 5,500 square foot house with a second, you could call it the grandmother apartment, but it is a 2,800 square foot 4-bed, 4-bath, all attached, going up the hills in in Old Town Park City at the entrance to Deer Valley, walking distance to everything in the town. We acquired these for $1.8 million. The current market value of these properties is about $3 million. At the peak, they were worth close to $6 million. This was a property that when we acquired it, the builder had gone bankrupt, and it took this long for us, for finally the lien holder to eventually unload this property. It did not have a certificate of occupancy, so this was the type of property. One of the reasons for the significant discount to market value was that we had to do our due diligence to ensure that this property could be finished and any of the builder defects could be rectified by our team that we had in place locally and bring this through to a certificate of occupancy of these two high-end luxury Deer Valley homes. So at the $1.8 million purchase price, we've subsequently put in another $400,000 to this property, bringing about $2.2 million in basis with, that's a conservative $3 million market value. It's potentially worth up to $3.3 million if we were to liquidate this ski season. And it's really a showcase property. You can see the deck in the upper left. It actually has views of Park City Mountain Resort. It's right at the entrance to Deer Valley Resort, so you can walk down your driveway and jump on the Deer Valley shuttle right to Deer Valley Resort, or you can walk to the town lift of Park City Mountain Resort and just get out on the lift. That's just about a 5-minute walk from the house. Pretty spectacular, and all of our partners have started booking it for ski vacations for next spring. So the net result of everything that Greg and I just kind of walked through with respect to how we find the great deals and these phenomenal properties that we're cobbling together for our investors is that our property values have already increased by over 35% of what we pulled together since acquisition. So that then results in a current net asset value of the portfolio at $114,000 per unit. So what does that mean? Because I have some new potential investors say, well, if your portfolio is up 35%, is it too late? Should I have gotten in earlier? The answer is no. The answer is that there's still significant value. That net asset value of our portfolio at $114,000 per unit is actually, we're selling at a discount to that. Our current subscription price is $104,000 per unit. So the day you invest, it's instantly accretive given the assets that we have under management. We also know that those great deals that Greg articulated in Big Island and Palm Beach Shores, when those remodels are complete, that net asset value will actually go up because we haven't factored in the value creation that we've done in those two markets. And then the future acquisitions, we're still on track to keep improving that net asset value. Separately, a return to peak values could double your investment. So when others ask, what does that mean long term? Well, both Greg and I, we're limited partner investors ourselves. We put our own money in the fund. I tell prospects that my daughter's college fund is in this fund, and what do I expect to get out of it? Well, if someone puts in $1 into our fund, we kind of expect a 2x return of capital over the term of the fund. And that's just on the real estate investment. So then if you look at the chart at the bottom of the page, in addition to the property appreciation, you're going to see returns from the property usage rights that you get with each incremental unit investment in the fund. So for example, a 1-unit investment at $104,000 subscription price comes with 2 weeks of annual vacation anywhere in our portfolio, which has an estimated 10-year vacation value of $100,000 to $200,000, depending on which properties you visit at which point in the year. And you can see that scales up with other incremental investments. A 1.5-unit investment in the fund has 4 weeks of annual usage. Now, those weeks of annual usage, you can either use for free vacations, which has this lifestyle dividend component, or, as we've talked about earlier, you can return those to the fund and take a rental dividend as a yield that accrues and is expected to get paid out annually. Or lastly, you can convert that into what is called Elite Alliance credits and use that across their portfolio, which Greg's now going to walk you through what the Elite Alliance is all about and how that makes our offering even more valuable.
So Equity Residences has a partnership with Elite Alliance, and by becoming a partner with Equity Residences, you can become a member of Elite Alliance as well. And what that enables you to do is it enables you to take those usage rights you get from your investment. So as an investor in Equity Residences Villa Fund, depending on your level of investment, you might get 2 weeks or 4 weeks or 6 weeks of guaranteed usage every year. and you can take and convert that guaranteed usage into usage of our partner properties through Elite Alliance. And what I want to stress here is these partner properties are amazing resort properties, not just in the U.S., but all around the world. One of our partners was recently in Italy, enjoying one of the properties over there. I personally have been to a property at Esperanza down in Cabo. Amazing property. It's roughly 3,000 square foot, 4 bedrooms, 5 baths, large kitchen, great room, private lanai with barbecue, private outdoor jacuzzi, but also all the amenities of the resort, the concierge services, the access to the beach, etc. So it's really nice high-end properties that you're getting access to. And these properties, as you can see from the list here, vary from mountain properties, golf properties, beach properties, more cultural type properties, and they're spread all over the world. You can go to South America and be in Buenos Aires and then head up to Malbec for the wine country. You can be in Italy, as I mentioned. You can be in Bermuda or the Bahamas, or you can be in the U.S. if you want to take a nice ski trip to Lake Tahoe or Telluride. It just really expands your options. And what I'd also tell you is this portfolio of properties that Elite Alliance has access to and that you can exchange for is actually a growing portfolio that continues to expand, just as our portfolio within Equity Residences continues to expand.
So Greg, how do you use this portfolio? How does it work?
It works pretty straightforward. You make the election of how you want to use your usage rights. You choose either to convert it into some points that can be used towards these Elite Alliance properties. You can convert it to a capital dividend where you can receive rental income, or as I said, you can use one of our properties. If you convert it to those points, once those points are put into your account with Elite Alliance, they have a really simple, easy-to-use interface that you just go on, select the property and time period you want, and you work through their process to schedule and book that. They also, you can, if you prefer, you can also pick up a phone, give them a call, and talk through what would be the best vacation option for you.
And I just want to reiterate that these really are 5-star white glove resorts. This portfolio is an exceptional portfolio that the partners at Elite Alliance have pulled together. And irrespective of whether our current 8 properties are the perfect fit for your family vacations, we know our 8 properties are a phenomenal investment, and we will continue to grow our portfolio with really great vacation investment properties. And this now portfolio provides you with kind of unlimited access to then luxurious vacations that are a privilege of your investment in the fund. So separately, another privilege of your investment in the fund is what we're calling the equity experience. You don't just show up at your Equity Villa Fund villa to a cold, dark, waiting, vacant vacation property. We ensure, so we have an internal property management entity that ensures that when you show up, the house is ready for you. There's quality linens, fine toiletries, there's beach and pool towels and chairs, there's sports equipment, great digital TVs. We actually even put fresh flowers and requested food and beverage in the villa so that when you show up, it's really ready for your family's arrival. And we'll take special requests.
Yeah, we really want this to feel like it's your home. There'll be, depending on the property, there might be beach cruisers there that you can jump on and go for a ride on the bike path with your kids, beach chairs and boogie boards that you can go down to the beach with.
Yeah, we've got stand-up paddle boards in Hawaii, we have stand-up paddle boards in Florida, kayaks in Florida on the property that's sitting on the water.
So it's really meant to be your property to use and enjoy. You have access to all the amenities of the property because we want it to feel like it's your home.
So given that, here's an investor testimonial. And anyone interested in our fund, we would be more than happy to connect you with some of our current limited partners and let you get their kind of firsthand experience of both their visits to our properties and their rationale for making this real estate investment. This is an investment management executive in Newport Beach. You can kind of read the quote there for yourself. But I will add that we have a slew of recent investors that I call smart money investors, in that they're investment management executives, they're private equity partners, they're wealth management managing directors, they work in family offices. So we have had several of this investment industry folks who actually, once they see our model, they understand that, hey, this is a great both investment that's low risk, that they can put long-term capital, and then get all these kind of rights and privileges of the free vacations or the nominal dividend that just also makes this just a really smart investment for some long-term capital in this asset class. And we'd be happy to connect you with them to gain their perspective if you're interested.
So to wrap it up, what does all this mean for investors? You make a one-time upfront investment starting at around 100 grand for the equity villa fund. You get a preferred return. So preferred return meaning you're getting a return before the fund managers or anyone else is getting a return in the form of that vacation usage or rental income. You get the long-term capital appreciation from holding a low-risk asset. Now, I want to explain why I call that a low-risk asset. We don't use leverage to leverage up these properties. We're capped at no more than 25% debt across the portfolio. And what that enables us to do is it means that we're never going to be in a position where we're forced to sell the properties at fire sale prices, no matter how bad the economy is. And in fact, many of these properties we're buying below construction cost at all-time lows for the past 10 years. And so therefore, we're able to mitigate the risk. We drive a high cap yield where we can bring rental income that more than covers all the expenses. So there's not really a risk of us losing this asset. They're in prime locations. They're going to hold and have value. And that's why we call it a low-risk asset. Property values have increased over 35% and continue to go up. And the estimated net asset value of the portfolio is $114,000 per unit, and that excludes the two most recent acquisitions that are actually accretive to the portfolio, and we'll add those into this calculation once the remodel is complete. I'd like to now open it up for questions. So there's a little box on your screen where you should be able to click to type in questions. So please go ahead and do so. And we've actually got a couple questions coming in already, but if anyone else has more to add, please do so.
Okay. The first question that got posted was, what are your fees or management fees, or what does the GP get out of this fund? It's a simple answer. We set this up as a standard private equity fund that's a 2 and 20 model. There's a 2% management fee during the interim of the fund, and then a 20% carry on the back end of the capital appreciation proceeds after 100% of the invested capital has been paid back.
Okay, we've got a number of questions that continue to roll in. I'll take a quick, easy one. How many properties do you currently own? We currently own 8 properties in the fund. How many partnership units have you sold? We've sold right around 50.
There's 60. We've got 60 units sold.
To about 50 investors.
To about 50 limited partners.
Yeah.
That's right, Greg. The dividends, can they be paid out annually in cash? That's a good question. The answer is yes, that is the expectation. We are accruing dividends currently during the acquisition period because we think it's in the best interest of the fund to put all of our available cash into our real estate purchases. However, once we start the 10-year utilization period, our expectation is that annually we will be, once we close the books for the fiscal year, we would distribute the dividends annually in cash payment. So, Greg, let me ask, I'll read a question for you, Greg. How many weeks per year is each property available for investors, and how far in advance you need to reserve? So
the properties, the amount of usage available depends on how much you invest. So the minimum investment is $104,000. That gives you 2 weeks guaranteed usage plus unlimited space available. If you increase your investment to roughly $156,000, you get 4 weeks of guaranteed usage and unlimited space available. And for $208,000, you get 6 weeks of guaranteed usage and unlimited space available. So it's really scales based on how much you invest, and that's kind of your choice to make. Now, I will say, though, that depending on how you use this, if you convert them to Elite Alliance points, and we had a question about that, so if you convert them to Elite Alliance points, what happens is if you go at slower times of year to the Elite Alliance properties, that those 6 points that you would get for converting can actually potentially be used for 3 weeks of vacation. So John here, he's going to Bahamas later in October, part of scouting out some property opportunities for our fund to buy in the Bahamas. But he's going to be in the Bahamas in October. And John used, I believe it was 2 points for his week that he booked in October in the Bahamas. Well, he got 6 points for converting over his equity residences stay. So now he used 2 for this week in Bahamas in a very high-end luxury property right on the beach. And if he potentially wanted to, he could have stayed 3 weeks if they were 2 points each and converted 1 week of usage in our fund to 3 weeks in Elite Alliance. Now, obviously, if you're going the opposite direction, say you want to stay Christmas, well, Christmas might require 9 points. You get 6 points for turning in one of our weeks. So for 1.5 of our weeks, you would convert and have potentially a week at Christmas for Elite Alliance. And those point values vary a little bit by property as well.
So it looks like you're also kind of asking a follow-on to that question by rephrasing it a little bit for some clarity. Is any particular property only open to investors a certain number of weeks per year? I mean, the answer to that is our current model is that we reserve the 3 highest grossing weeks across the portfolio at each property to ensure we can hit our rental income goals for the fund. Now, that's not just holidays in many cases. So in Deer Valley, it's Sundance Film Festival. In Palm Springs, it's Coachella. So each location, there's about 3 weeks where we can generate a disproportionate share of our income where the property rents at nearly double what the average peak season rate is.
And that's actually something we may not have made clear enough. The partners go in and they reserve what weeks they want in the property aside from the 3 weeks that John mentioned. And then we rent out the remaining available weeks, and that rental income is what pays the operating cost of the properties in the fund. And that's one of the things that's so cool about our model is many other destination club type folks aren't real investments. You're having to write checks every year. If you want to leave the fund, you're getting back less than what you put in. This is a true investment, and part of that being a true investment is when you as partners aren't using the properties, they get rented out so that you're not writing that check every year. You get the free usage of the property.
Yeah. And so to carry that conversation, because there's several questions about the usage piece. So we open up the window to our partners at about 9 to 18 months out. So annually, we have a reservation window in March or April of each year that then starts for the next holiday season starting October 1st. So you then are able to book your reservations if you're prepared. So a year out, if you know that you have kids' spring breaks. That's really, our partners are really just booking for children's spring breaks kind of a year out. We give them that right. And frankly, renters have not yet booked those weeks a year out. So there's really a first right of our partners to book those weeks. And then partners that if you're not ready to book your weeks, you can carry those weeks throughout the year and use them first available whenever is available.
So there's a question here about when do investors get the cash out, and we have a 10-year holding period for the fund. So we're raising funds and buying properties for 1 more year. So next July we're going to stop raising funds. We're going to close out and buy the last properties for this fund, and then we go into a holding period where we'll hold the properties for 10 years. You'll get that free usage every year, and then at the end of the 10 years, we'll liquidate the portfolio. The investors will get their money back, and we'll distribute profits to the investors.
Yeah, and I will clarify that we have a 10-year holding period. It was really to ensure we can catch the next real estate peak. So we very well may start liquidating properties in 5 to 7 years, and it'll most likely be in areas like Florida, Hawaii, California. When we can reap a 2x return of capital across properties, we would start some limited liquidation. So we're not expecting to try to liquidate 20 properties in year 10, and we'll phase that in the best interest of our investors. There's a question about the $114,000 net asset value and what did it start at? So one of our very first charter rounds was at around $92,000 per unit, and then we've raised the price every quarter or every 2 quarters. We have a 3 to 4% price increase. So we closed the charter round at $99,000 per unit in the end of the summer, and the current subscription price that's in the offering memorandum is the 104 price point.
But what I will say is that every one of our acquisitions has been accretive. So even when we raised those initial funds, when they were put to use in the first property, the net asset value was immediately higher than what the initial investment was. And that's why we have to keep raising the prices. We can't have a huge gap between the net asset value of the portfolio and the current offering price. You know, the current offering price is definitely lower than the net asset value, and it will continue to be, but we can't have that gap be huge.
Someone asked about last-minute opportunities. It's a great question. The answer is yes. Built into our model is unlimited space available use. So we really have constructed our operating model as if, hey, we are all owners of the properties, and it's collective asset ownership, and that we own these properties with other people. How would we manage these and share these properties? So at some point when the property manager knows that there's a diminishing kind of point of return when we know we're not going to be able to rent a property and it's going to go vacant, that becomes available to our partners, and it's first come, first serve, and anyone can book it, and there's unlimited amount of those stays. You just pay a visit fee to cover your variable operating expenses of the property management setup and the cleaning fees, et cetera, which on average is about $450 for the entire week. Great.
So there's a question about, is our net asset value based on appraised cost or actual cost or appraised value? So we have our actual cost of the properties we have. That's basically our cost of capital to buy those properties. But what our net asset value is it's based on the appraised, not appraised value, but the comp value as determined by local real estate agents for us, because we don't have an appraisal done, you know, multiple times a year, but adjusted for any debt or outstanding liabilities and any cash on hand. So effectively, if we were to liquidate the portfolio today, or isn't that 114,000 number, that was actually from April. So if in April we liquidated the portfolio, we would have been able to have $114,000 per partner available to us after all liabilities were covered. That number, as we said, is going up due to our new acquisitions that were accretive.
Yeah. Well, and so along those lines, somebody asked, what was the 35% return over what period? That was really an 18-month snapshot. Frankly, our properties, when Greg talked to you about the Big Island and the Longboat Key, that type of acquisition we did in the Big Island, we've done that in many of our markets in Deer Valley, where we're actually seeing 20 to 30% appreciation in this 90 to 120-day window from us deploying our capital, doing the remodel, and then kind of reaping those gains for our investors.
So John, we've got another question here. Can our partners ever be asked or required to cover shortfalls in operating expenses?
So that's a great question. And since it is a limited partnership, we do have to put something in the partnership agreement for those types of situations. We got creative in that and have already built into our model an optional annual operating fee that is to be used in the cases, in the fringe cases. So some people ask me, what's the worst case, right? And I don't think there's a worst case scenario where our real estate portfolio goes negative, considering we're already buying below construction cost, below market value, 10-year historical lows. But on an operating side, if there are cases, macroeconomic conditions where people stop taking vacations and the Hawaii tourism market collapses or the Florida tourism market collapses and we don't have the rental income, our partners would have to offset any shortfall in that. We've written it in as an annual operating fee that's capped at $2,500 per unit. So that $2,500 per unit, even when equated to two weeks of free vacation, is quite a valuable metric, even at that point. We're not forecasting that. We haven't had that yet, and our model doesn't forecast us having to use that.
Right. No, we don't anticipate an operating fee, but if there was one, what's the maximum it could be?
$2,500 per unit.
Yeah, so it's almost a negligible amount. And the other thing I'll mention is that when we originally looked at this fund, we were basing our revenue expectations off of really the bottom of the market in the Depression. I mean, it was 2.5, 3 years ago, we were pulling all the data and doing the analysis, and our revenue numbers, because of the recovery, have actually all been higher than what we had anticipated. So it would take something on the magnitude or greater than the magnitude of what we went through with the Great Recession to really disrupt our model.
There's a quick question: do the members of the Elite Alliance get to use our properties? The answer is yes. So when one of our investors deposits their week onto the Elite Alliance, for them to then use one of the Elite Alliance properties, those Elite Alliance members then have access to that week we deposited and get to use the properties. And actually, that's already happening. We've had Elite Alliance members use our properties. They're very happy with them. And actually, our first Elite Alliance member that went to Maui actually became an investor and is now a limited partner. So Greg, here's one for you. How do you guys find such good deals? Off-market, networking with real estate agents, pre-foreclosure, et cetera.
You know, I would answer it's actually all the above. I can give you multiple examples. We've had one example where a property was on the market. We did our due diligence. We understand it a little bit about the seller situation, and we realized that it should have been on the market as a short sale, but it wasn't listed as a short sale, and it just would never, the deal would never make sense the way it was on the market at the time. And this was, gosh, 2.5 years ago now. We actually went ahead and put a short sale offer in on a property that wasn't a short sale, and their agent combined with our agent and us convinced them that that was the way to go, and then we ended up locking up the property, and that was the one in Kapalua in Maui as a short sale. The one in Palm Springs that we have, that one was also a short sale that came on the market. It was completely underpriced. We locked that one up in less than an hour because we were really on that neighborhood down to the block and the house. It was kind of a funny story where shortly after we locked it up, the sellers realized their mistake and that they had priced it extremely too low and wanted to back out of the contract. We didn't allow that, and we moved forward and closed on the property. If you think about some of our more recent acquisitions on the Big Island, that's where we had contacts on the island that were in the know about what types of properties are coming into foreclosure, et cetera, coming out of foreclosure. And when the property on the Big Island became available, we actually locked that up right away. You know, literally the minute it became available, right behind us they had probably 30 other offers, but we were able to move first. We've had other properties where we've actually identified them ourselves before they've become available, just through driving through the neighborhoods, identifying a vacant property, inquiring into it, seeing that it is in pre-foreclosure process, and then working through the right local network to make sure that we're first in line to be able to pursue that property. In the case of Deer Valley, that was a property where there were some structural issues that had scared folks away. That was a case where we had to do extensive due diligence to really understand what would it take to put that property in the condition it needs to be in. It involved actually jacking up the property a little bit, adding a steel beam. But now that we've got that steel beam in there, the property is just an amazing property. It's probably one of the most amazing properties in our portfolio. But that's something somebody else might not have been willing to do. So it's a long answer, but it's not just one answer.
So the last question we have here before we'll wrap it up is there a desired ratio between the number of properties in the portfolio and the number of partners? And are the partners limited? So the answer is yes. We scale linearly. We have an average of about 7 to 1 limited partners per property, which equates to about 9 to 10 units per property that we buy. So as we receive more money from limited partners, we go acquire more properties, and it scales linearly. And then what that model does is that for all the available weeks in a property, 40% of those available weeks is what is allocated to the limited partners for their usage rights. And then another 40% is what cash flows the portfolio. Now, most of our properties all cash flow anywhere from 20 to 30% occupancy. So that 40% utilization cash flows the properties and the fund. And I will give one example is that our Maui property for 2014 had a 55% rental occupancy and a 30% partner usage. So we're going to close the year at 85 to 88% occupancy, which is a great metric for a Hawaiian property. And since that property cash flows at 35% utilization, the 55% just generates significant cash flow for the fund. And the partners got the usage they wanted. They booked all the weeks they wanted and used 30% of the available weeks.
So we're going to have to wrap up now, but what I'd like to do is if there's any additional questions, I'm sure we haven't answered all of them, so please feel free to reach out to myself, Greg Sally, or John Long directly, and we'll be happy to spend more time and walk you through as much detail as you'd like to hear. You can see our contact information here, our phone number, as well as the general email address. If you just add Greg instead of info or John instead of info, you'll get us directly. But we're always happy to, answer any questions and share more about how our funds work and more of the detail. Thank you, everybody, for joining.
Yeah, thanks, everybody, and look forward to following up with each of you one-on-one. Thanks.